Oh man, could we be facing a US sovereign debt crisis? In other words, could the US be running out of money and not be able to pay their debt obligations? Let's take a look, because we've just seen a letter from Janet Yellen, the Treasury Secretary, warning that the US government can run out of money unless debt ceiling is lifted. Now, let's explain how this works. So, the US has what is called a debt ceiling or a debt limit, which is the amount of money that Janet Yellen, the Treasury Secretary, and the US as a whole can borrow to meet their existing legal obligations. Not for new spending, for existing previous spending. So that includes Social Security, Medicare benefits, military salaries from previously, interest on the national debt, tax refunds, all these kind of things existing from before. Now, over the last 2 years, there was a suspension of the debt limit. In other words, there was no debt limit. That expired on August the 1st. So as of August the 1st, the previous debt ceiling of $22 trillion is back into force. And what this has meant is that Treasury Secretary Janet Yellen is now saying that she is unable, it won't be long before the US won't be able to meet their debt obligations. So she's saying she's now using extraordinary measures, and just to quote her, she goes, this could cause serious harm to business and consumer confidence. It could raise short-term borrowing costs for taxpayers and negatively impact the credit rating of the United States. She also said this would likely cause irreparable damage to the US economy and global financial markets. And guys, we've got a little bit of precedence here. So if we go back to 2011, those of you who are following the markets then will remember this similar impasse happened under the Obama administration. And at the time, there was massive turbulence in the global economy, particularly for stocks. We saw at the time Standard & Poor's, the ratings agency, took the American rating agency from AAA to AA+, which is massive, right? Remember, globally, the US debt is considered risk-free, right? Anybody doing valuation of companies and studying economics, US is considered risk-free. So anything which compromises that has massive implications, not just locally in the States, but globally. A lot of assets are denominated in US dollar. A lot of debt is based with the collateral in US Treasury bills. And this will cause massive impact. Now, at the time, they did manage to resolve the issue. I'm going to come on to that in a bit. But it cost the US $1.3 billion, just that cost them $1.3 billion in just interest payments in that year, plus extra each year going forward. Now, my view on this, and I'm not a big fan of the politics, but this is a political thing going on right now. You've got a balance between what's going on with the Republicans and Democrats. Republicans, they refuse to support an increase in the debt limit unless they're saying the Democrats agree to spending cuts and debt reduction measures. Now, obviously, there's a whole bunch of political hoo-ha going on around here. And I think what Janet Yellen doing is almost raising the flag to say, look, we were here before in 2011. We don't need to let it get to that point again. Okay. Now remember, she wrote to the speaker saying we are now employing certain extraordinary measures to ensure that the government could continue to fund itself. Okay. Now she goes, once all available measures and cash on hand are fully exhausted, the USA would not be able to meet its obligations for the first time in its history. So this is massive. And I think what she's doing here almost is she's raising the flag. She's like, we've been here before. Let's not let this happen again, right? You gain nothing by playing chicken on this and letting this really go to the last minute. The economy doesn't need it. I mean, we got the backdrop of COVID. We know we're struggling. The confidence is low. And doing this will only be worse for consumer confidence. It's going to raise the short-term borrowing costs for taxpayers, and it's going to impact the credit rating, right? So the last thing they want is to be downgraded by rating agencies. That would be a nightmare given this environment. Now, It's a bit of an interesting one because these politicians have played chicken before on this. I think 2011 was a bit more of a stable environment at the time, which is probably why we got away with it. Do they really want to be playing chicken right now and risking a sovereign debt crisis with the backdrop of COVID, Delta? You know, we saw weak jobs figures. We don't know what CPI is going to be coming in at. Is that something we want to play with? And let's take a look at this. So let's take a look here. So what we can see, if I move me out the way, we can see that this is the US Treasury cash balance in blue. Okay, so you can see massive amounts of cash in this period, And now we're seeing that the cash is really starting to dwindle down. We don't know how much revenue is going to come in because normally fiscal revenue comes in through tax payments, and we don't know how much revenue is going to come in at this period because it's a volatile period. Now, there's a few different options here, but one is saying that if we do have a new debt ceiling scenario, that 600 billion US dollars could be taken out in liquidity as the government starts to fill its cash reserves. Now, what impact could that have for the economy? That's now risky, right? So we've got a CPI reading coming through, which if it's slightly hot, we can see maybe a bit of a taper tantrum come from the market. On top of that, you've got this debt ceiling issue, which is going to, by the way, come into fruition around the October-November time, because they're running extraordinary measures right now. That will start to see the cash dwindle by October-November time, which is also the date earmarked for the taper. So this could really be a testing time for equities and those of you invested in the stock market. We know, I made a video on this earlier. We've not had a broader S&P correction for quite a while now. Normally you expect a few percent correction every so often. We've not had a 5% correction for a good period of time. You've got the historically volatile September-October period coming up. On top of that, we got a CPI reading tomorrow, which we know if we see that come in on the hot side above the expectations of 5.3 year on year and 0.4 month on month, that could lead to a bit of a taper tantrum, right? Because if that comes in hotter, the Fed are more likely to start their taper sooner, or at least it's going to be on the agenda for the FOMC meeting. That, tied in with the fact that cash balances are dwindling, means that the Treasury will need to get their hands on cash. Okay, they need to build up their coffers, and because they need to pay their debt obligations. Now, as and when they're building their coffers, it means they're giving less liquidity to the market, right? So at the moment, they're giving liquidity to the market. They're buying bonds, 120 billion a month of assets. But soon they're going to want to fill their coffers, okay? So you can see how if they're pulling liquidity from the market, it can trigger the market to go risk off. And I think that's the broader concern here. For crypto, for equities, anything which is classed as a risk-on asset, that is the broader risk here we could see if this US sovereign debt crisis continues to play out. Ultimately, I mean, look, this has not got massive attention yet in mainstream media. Globally, it is on the radar. This is not just something for the US to be concerned about. And it's really not a time to be playing chicken with the global economy. And just hopefully they can resolve their political issues quicker than they did in 2011 and resolve this issue. Because the last thing the global economy needs right now is for people to be questioning the sovereignty of the US. I mean, that's the one thing that, investors kind of mentally think, oh, that's the safe haven. And if that kind of starts to dwindle, then it will be challenging moving forward. So there you go, guys. That's my take on this. Should we say imminent? No, I don't think it's imminent. We're still quite a way away, but it's something that's on our chart. That's my take on that US sovereign debt crisis. Hopefully they resolve it, but we'll keep an eye on it in the meantime. Thanks for watching. We'll see you in the next one.